Hello, let's cover NTES. Ticker symbol is NTES. We'll start by technical analysis. This is the long-term chart. We had the IPO of the company here at about $3 or $4 in early 2000. Then it came to almost zero. I believe the low was about 10 cents, and now it is a 18.60 dollar stock. Well, we have this symmetrical triangle formation over the long-term chart with support around 16.5 now and the resistance around 21. Let's check the short-term chart here again. Well, the stock almost touched here the ascending support, and maybe it will now reach the descending resistance until it decides to go up or down. We need to study the fundamentals to have a better idea of the future. So let's make some fundamental analysis. Well, this is the share count. You can see since the company's IPO in 2000 there wasn't much dilution for shareholders. The share count grew just 1.2% a year on average, which I welcome. And the market cap grew 59% on a compound annual growth basis. This with the base year of 2000. The current market cap is $2.42 billion, so this is already a medium-sized company. Let's check the balance sheet. Long-term debt is 101 million now, but that's not much for a 2.4 billion market cap company. And the current ratio is 6.13, which is very healthy. It means current assets are 6 times more than current liabilities, and of those current assets, 95% of it is cash, I believe, and marketable securities. The company has $504 million in cash, so this is a very healthy balance sheet. Now, as for revenues, well, there was very strong growth here since 2001. It was $3.4 million revenue in 2001 to $277 million in 2006, so extremely strong growth. But analysts 407 and 408 are expecting much slower growth. I'm not sure why. Just 8% here in 2007, and 408, let me see, 347.6 divided by 299.7 gives me 16% growth for 408. Revenue compound annual growth rate with a base of 1999, when it was 1.88 million, was 104% for NTES, and for the industry average 37.8%, but this is just growth in 2006 from 2005 levels. Gross margin for our company is very high, 82%, and the industry average is also high, but not so much, 64%. Price to sales ratio 8.74 for NTES, and for the industry average 3.4. Gross margin has remained very stable and very high here, above 80%. So this is a very profitable business. Let's check earnings per share and net margin. Well, you can see the company lost a lot of money here in 98, 99, 2000, 2001, and in 2002 it started to be profitable. And I don't know if you remember, let me put here the technical chart. Look here how in 2002 the stock started a huge bull run when fundamentals turned to profitability. Well, now the net profit margin is the highest I've ever seen, 57.4% of net profit margin in 2006 is really incredible. And the price to earnings ratio, considering 2007 average analyst expectations of $1.17, is just 15.8 for NTES, and for the industry average it is 34. I believe the company can beat this number, even though in the fourth quarter revenues declined sequentially. I believe they will grow again, because this business just won't stop in the near future, I believe. And with this kind of net profit margin, 57% is really awesome. I believe the company will beat expectations going forward. As for my valuation model, I believe I'm being quite conservative here, since I consider a dilution factor of 2% and the company has been buying back its own shares. Revenue compound annual growth rate for the next 3 years just 10%, but it can be a lot more. As we've seen, it has been, let me see here, no, not this chart, just a second, yes, this chart. Historically it has been 104%, and I'm considering just 10%, well, because I'm worried with also as other analysts that this sequential revenue decline will mean something for the future. And in 2006 revenue growth was, let me see, 277 divided by 199 was 39%. So 10% is very, very conservative, I believe. Final net profit margin estimate 50%. It was 57.4% in 2006, so it can also be more. Earnings per share multiple estimate. Here I put the industry average of 34.3, and even with these very conservative estimates, the stock is really attractive, with a share price compound annual growth rate expected for the next 3 years of 35%. When it is above 16%, I consider the stock attractive. So to the question, attractive? Yes, of course. My optimal selling price would be $29.25. This is the price where the share price compound annual growth rate would start being less than 16%. But I believe there can be, I could put higher estimates here. So on a 1 to 10 scale, I give this stock, where is this, an 8, and I find it attractive. Thank you, bye.